Hey guys, it's Dan here. Today we're gonna talk about working capital management. In my opinion, working capital is one of the most important financial things you have to understand and to know because literally this thing can break your neck of your company. In this video you will learn what working capital is, how to calculate it and how to improve it in the long term. So let's get started. Well, first of all we have to define what is working capital. If you Google working capital, you will see that there are different definitions and different formulas, what is included and what not. So in my opinion, and the topic of this video is going to be trade working capital management. Why? Because in my opinion, when you look at the company level and what you want to achieve with working capital management, the trade working capital management is definitely the one you want to manage. So let's get started and look at what trade working capital management is. So the definition says it is current assets minus current liabilities, which means basically this is the money available for you that you can use for your daily operations. So this definition sounds super theoretical and it's kind of difficult to understand. So let's start with an example and it's going to be much easier to understand. Well, first of all, where do we find current assets and current liabilities? In our balance sheet. So for our example, we're going to start with a balance sheet. Okay, now let's have a look at our balance sheet. Obviously we have two sides, assets and liabilities, and inside I put the current assets and current liabilities on each side. So in the current assets we start with cash, which is the money we have on our bank account. Then AR for accounts receivables, which is the money my clients owe me. Then inventory, which is the stuff I have produced but not yet sold. And then on the liability side, I have accounts payables, which is the money I owe to my suppliers. So it's supplier debt. And last but not least, short-term financial debt, which is the debt I owe to a financial institution with interests in the next 12 months because it's short term, it's current. Okay, now let's add some numbers to our balance sheet to make it easier to understand. So we have two years here, 2018 and 2019, that I have filled with numbers. First of all, let's start with 2018. We can see that cash is going up from 80 in 2018 to 120 in 2019. Accounts receivables are going up from 20 to 40. Inventory is going drastically down from 54 to 15. And on the liability side, accounts payables are going up 64 to 79. Short-term financial debt is going down from 70 to 56. Okay, now let's try to calculate working capital just for 1 year. Remember the formula? Current assets minus current liabilities. What does it mean? For 2018, when we take the sum of my three current assets, they sum up and it's 154. And on the other side, my current liabilities sum up to 134. So when I do 154 minus 134, I see that I have a gap of plus 20. So I have more assets than liabilities. So I have a positive working capital in 2018. Now let's look at 2019, same exercise. Current assets minus liabilities. We're going from 175 as my assets, going up, and liabilities stay the same. So when we do 175 minus 135, we see that we have now plus 40. So our working capital has improved. What does it mean now? Let's find out. Okay, so these two numbers, they tell us a lot about our working capital. First of all, when we look at the absolute value here for 1 year, it tells us that we have enough current assets to cover our current liabilities, which means we are able to pay right now for the next 12 months of debt coming up on us. So that's the first information, is kind of the absolute value. The second information, in my opinion, is even more important. It's the difference. What happened here? as you can see, our working capital has improved. We went from plus 20 working capital to plus 40 working capital. So the question now is, why did we improve and how can we improve even more? So I'm going to show you a very simple method that's gonna work 100% of the time, and it's like this. Basically, the goal of the exercise, you have your you have your current assets here, your current liabilities here. You do not have the cash line, because the cash line is what you want to calculate. You want to try to understand why your working capital has improved and what is your impact on your cash. That's what you want to know. So in this case, we're gonna first look at the balance sheet effects from one year to the other, and then think about the cash effect of these balance sheet effects. So let's start first with the accounts receivables. We can see that our accounts receivables went up by 20. So in the balance sheet, the balance sheet effect plus 20, which means basically our clients. That's a bad sign first. Okay, which means here our clients did not pay us as fast as last year. That's why our accounts receivables are going up. Then inventory, here we can see we have done a good job because we are able to reduce the inventory, which means actually when you're going from 54 to 15, that you were able to sell last year's inventory. So when we look at what happened in the balance sheet, that's a drop of 39. So balance sheet effect minus 39. Next, look at the liabilities. Accounts payables are going up, and they're going up by plus 15 in the balance sheet. And the short-term financial debt, which means the debt we have to pay in the next 12 months, current debt, is going down by 14. Okay, that's the balance sheet effect. Now let's think about what the balance sheet effect has an effect on our cash. What is happening here? What does an increase of accounts receivable mean? Yeah, I just kind of told you that. That's a bad effect here, because that means that our clients paid us less fast than last year. That's why it increased. So that's bad for our cash, because our revenue is still, the money of our revenue is still in our clients' pockets and not in our pocket. So that has a negative effect on our cash flow. Inventory going down, that's a good sign because we were able to sell our inventory. So that's a cash in for us, that's a positive cash effect. So plus 39. Then accounts payables. Accounts payables going up, that's a good sign because it means that I paid my suppliers later than last year. As you can see, last year my accounts payables, I had a debt to my suppliers of 64, and it went up to 79, which just means I paid slower. That's a good sign, because when you pay slower your supplier, it means that it's right now it's a positive cash effect because the money is still on your side. So that's plus 15. And the last one, short-term financial debt going down. It means you have paid back. As you can see, it's going down from 70 to 56, the financial debt. It means you have paid back debt. That can be a good thing in the long term, but obviously for my cash, when you pay back debt, that has a negative effect. Okay, so now when we sum up here, minus 20, remember what's the name of the game here? We want to calculate a working capital change, which means we want to know what was the effect of the working capital on our cash. So we just have to sum up our cash effect positions here, and when we do it, minus 20 plus 39 plus 15 minus 14, that's a positive of plus 19, which means my working capital variation from one year to the other had a cash effect of plus 19. Sorry here, little rounding difference. You see it's plus 19, here it's plus 20, it's just because of the roundings, but you see the numbers match here. So from one year to the other, we were able to understand why we have a working capital increase of plus 20. Okay, now that we know how the working capital change is calculated, I wanted to show you what is the effect on the different financial statements. Financial statements here, you have the balance sheet, profit and loss, direct cash flow as well as indirect cash flow. So let's start with the P&L. My working capital is basically the difference on one side, when you look at the accounts receivables, between my revenues and my cash ins, and on the other side, when you look at inventories and accounts payables, it's going to have an effect on my operating costs that will at some point translate into the operating cash outs. So let me explain this. Imagine you have a revenue of 100, right, for 2019. We have seen that we have an accounts receivables impact change. When you see my accounts receivables are going up by 20, which means in this very simple example that my revenues of 100 have not been fully converted into cash, because when you look at how much cash ins I got from my hundreds of revenue, it's only 80, because 20 of it is still in my client's pockets, and that's why I have my accounts receivables going up. On the other side, on the cost side, you imagine my operational costs were 80. Then what is happening? Why do I only have 26 here going out? Well, first of all, because I was able to sell my inventory from last year. So I do not have this cash out of 39 here, because it's already gone from last year, so not this year. And second of all, I have my accounts payables going up, which means that I'm paying my suppliers later, so not this year. So if you look at the impact from my P&L, my operational cost of 80 only hit my operational cash outs by 26, because the difference is linked to the decrease of inventory, which has a positive cash effect, as well as the increase of accounts payables, which means I'm paying my suppliers later. And there is another effect that you do not see in the P&L. As you remember here, my financial debt is going down, which means I have paid back some loans. Obviously my loans, the repayment of loans is never in the P&L, but it's going to be in your cash flow, in your financial cash flow, in the debt repayment. So to sum up, when we look at our P&L impact here in this example, my P&L impact in 2019 is 20, but my cash flow impact is 40. So why was it possible to have more cash than result? Well, that's what you're gonna find out in the indirect cash flow, where you are always going from a P&L metric to a cash flow metric. So in this case, we're starting with the P&L impact, which was 20. Then something happened, and our cash impact is plus 40. And the something happened is the working capital change we have discussed earlier. So here to sum up the idea, in 2019, I was able to generate additional profits of 20 and additional cash of 40, which is obviously more than 20. And the difference between both is explained because I was able to manage properly my working capital. That's why 20 plus 20 equals 40. Now, I know that this is a lot of information, and financial statements are quite complicated to understand if you are just getting started. So I made a pretty extensive video about it that I'm gonna link here in the description and in the description below, by the way. So if you want to know everything about the different financial statements, make sure to watch this video. It's about half an hour. It's very extensive, and you will learn a ton of stuff, especially if you're a beginner. Okay, now we have learned what is working capital, how to calculate it, where it is important in our financial statements. Now we're going to talk about how to improve our working capital. So first of all, let's look back at the 4 assets and liabilities which are involved here, which are accounts receivables, inventory, accounts payables, and financial debt. So how can we improve our working capital to get the most of our cash here? So first of all, accounts receivables. The accounts receivables should be reduced. Why? Because look at the example here. My accounts receivable went up by 20, and look at the effect here. My revenues of 100, I did a great job of selling, so 100 of revenues only converted into 80 of cash because my accounts receivable slipped. So that's something you want to avoid. So make sure your clients pay you on time in the best possible conditions. So a collection here is very important. I give you an example. I was working for a company once, and our collections were very bad, and sometimes it can be something technical, super stupid basically. They were not able, it was a lab company, and they were not able to send out the letters to get the money because at some point in some lab there was no ink for the printers. This kind of stupid things. So pay attention to collection. Make sure your clients pay you. And sometimes it's maybe better, you know, obviously you wanna have some sales, but sometimes it's even better maybe not to sell to anybody, because if you know that someone has a very bad credit rating, then the risk is there that he's not gonna pay you. So it doesn't matter if you have a lot of revenues, because if your clients are not paying you, well, that's bad for you. So be mindful here. Accounts receivables, very important. Think about collection here. Second point, inventory. You should, as best as possible, reduce your inventory, which means do not overstock, especially if you are a young startup. Obviously you wanna get started, you wanna build stuff, you wanna produce your final goods, and maybe you're gonna be tempted and say, okay, I'm gonna buy bigger quantities so I can get bulk prices and stuff like that. I think we all made that mistake, and I think that can be a very costly one, because if you're not able to sell your inventory, and that's basically what happened here in 2018. You see, we had a very high inventory, and it took us 1 year to sell that inventory. So in 2018 we had a big cash impact because we were not able to sell our inventory. So think about it. Inventory costs you a lot of money up front, so inventory should be as low as possible. There is a reason why. Look at McDonald's, for example. McDonald's, you can think, well, they're good, they're bad, or whatever, but when it comes to inventory, they are pretty good because they do stuff on demand, right? So that's because they don't want to overstock. So that's a very important point. Next, accounts payables. So your supplier debt. This one should be as high as possible, because look at our example here. Our accounts payables went up by 15, and it has it had a great cash impact because we are paying our suppliers later. So in this case here, first of all, make sure you're not paying your supplier too early. Let's say, imagine you have a payment term of 30 days. Do not pay him after 20 days because you're gonna lose stupid money here. And make sure, especially if you have a good relationship, and if it's not a huge supplier, make sure you discuss payment terms. That's very important. Look at the payment terms in your country. Let's imagine the average in your industry and in your country is 30 days. Try to bargain with your supplier that you're gonna pay him after 30 days and not before. That's very important. And last point, financial debt, or the repayment of your short-term financial debt. Well, that's kind of a bit of a tricky one, because short-term debt, you have 12 months to pay it, right? That's why it's short-term. In this case, it really depends, because if you have a very high interest rate on your short-term debt, let's imagine you have like credit card debt or this kind of stuff, and very high interest, then even if it's bad for your working capital because you're cashing out earlier, I would definitely recommend to pay your financial debt as early as possible if you have a huge interest rate on it, because you're gonna pay a lot of interest and lose money in the long run here. It depends and then obviously if your interest rate is very low, or even 0% financing, for example, for zero, then you can stretch it as long as possible, which means up to 1 year, because that means that your cash out will happen later, and if you do not have any damage because your interest is super low, let's say 0 or 1% or something like that, then try to match it as long as possible. So yeah, that's how to improve your working capital. Next week I'm posting once a week every Sunday. I wanted to tell you that next week the topic will be cash conversion cycle, which is kind of the same topic as we did today, but it's not going to be about working capital, but it's going to be about cash conversion cycle. So if you're interested in DSO, DIO, DPO and all these things, I will explain this next week. So make sure to subscribe to our channel, to like that video if you like that content, and see you next week. Bye bye!